Good evening, ladies and gentlemen, and thank you very much for joining us here. As I pointed out, this is the 9th event that I've done at the State Bank of India Banking Conclave, so it is a privilege to be back again with some very eminent CEOs to talk about the road ahead for the Indian economy. As Mr. Khara was pointing out, you talk to anybody at this point in time, whether it's multilateral agencies, people in government, foreign CEOs, domestic CEOs, I think there is consensus that India is relatively better poised today. Of course, we are living in volatile times. There is a fair amount of turbulence. There is, of course, uncertainty on where we are going to be headed as far as rates are concerned, what is going to happen on geopolitics. But within that milieu, India is resilient and India is doing better in comparison to a lot of the other developed economies. But the question, though, is that for this to be India's decade, do we have the building blocks in place? And if we do, what else needs to be done? Where do we need to accelerate momentum? Where do we need to intervene? What kind of urgent action is required to be able to ensure that we can actually capitalize on this opportunity? So without further ado, let me get started with our CEOs today to draw out that action agenda for change. And I am going to start with you, Mr. Khara, because you are, in a sense, the pulse checker of the Indian economy. So let me get a sense from you. I mean, it's been a stellar FY23 for the banking sector, and I'm glad that the theme this year is on what banks can actually do to further accelerate growth. But is this going to be sustainable? Is this replicable? Are you starting to see some signs of nervousness coming in as far as the economy is concerned? Credit offtake has been strong. Do you expect that to continue? Net interest margins, pressure expected given the fact that rates are moving higher? An outlook really as far as the mood is concerned.
Thank you, Shereen. Well, of course, when it comes to banking system, it is proxy to the real economy too. So when I say it's proxy to the real economy, how strong the economy is, that will get reflected in the banking system as well. So as you rightly mentioned that, in the current financial year, probably India stands as the most shining star across the globe, and accordingly it has got replicated into the performance of the banking system as well. So I think the way I look at the scenario is that you talked about whether it is sustainable or otherwise. To my mind, so long as the risk is understood well, the risk is priced well, I think there is no challenge to the system. And I think the learning which we have from the past decade, when the last infrastructure story got unbounded and a lot of growth happened in the power plants and stuff like that, that was a point of time when perhaps the equity was nothing but the hybrid debt. So I think to that extent there is a learning which has been incorporated well by the system, and today it's not merely the equity but the color of the equity is looked into while the lending is being done. So that's one of the important component. And second very important component is, last time when the whole system went through a meltdown was a point of time when corporates were already highly leveraged. This year when we are seeing the growth story, corporates had almost deleveraged themselves. So I think that is the other very important component that gives us a confidence that perhaps the path which we have started treading is probably maintainable. The third important component is from the ecosystem. Last time when all this happened, the social infrastructure in terms of insolvency courts were not in existence. Losing the control of an enterprise was more of a fiction. Today it has become a reality. So I think that has brought in the required discipline on the part of the corporates. The ecosystem in terms of bureau, ecosystem in terms of the strengthening of the other infrastructure relating to ratings, etc., that has actually given us the confidence. Even GSTN and such kind of infrastructure has given us the credible data to evaluate the risk better. So I think I would say that from the infrastructure point of view, the banking system is much better placed. They have got the benefit of leveraging all these ecosystem partners and arriving at more scientific decisions, and they can assess the risk much better. They are They're better equipped in terms of capital. So I think all this put together, it gives me an impression that today the banking system is much better placed, and probably the kind of growth which you are seeing is sustainable too.
Well, that's good to hear, and I thank you very much for very comprehensively setting out the context of what is different this time around. And you're right in pointing out that, you know, to quote the former Chief Economic Advisor, Arvind Subramanian's caution around the issue of the twin deficits, and those have been significantly improved, both as far as the banks are concerned, as well as corporate balance sheets, both looking a lot healthier this time around, as you point out. But Mr. Khara, given the fact that you actually have the banking sector that's willing to lend, and you have corporate balance sheets that are looking a lot healthier, the finance minister at a forum like this exhorting once again industry that why aren't you going out there and investing? What's wrong with Indian industry? Where is the risk appetite? Where are your animal spirits? Are you seeing any change in that? And why do you believe we're not at this point in time seeing an unleashing of the animal spirit, so to speak?
No, we are already seeing a fairly good pipeline of the proposals. It is, I can probably share the number with all of you here. It is as strong as about 2.5 trillion with State Bank of India itself. And also, let me share with you, last year we had seen almost about the proposals, in fact the fresh investment coming in about 20 trillion. This year it is already about 12 trillion. So that is a very clear reflection that people have faith in the demand in the economy. I think that is something which is most important. And I would say that if at all there is a demand in the economy, perhaps the corporates are willing to invest, corporates are willing to come with the infrastructure, and also the capacity creation too. And the second important component is the capacity utilization has improved to about 75%. So that's a very clear reflection that corporates are there to really take the opportunity to their fold and see to it that they contribute meaningfully. So I think I would say that, and last year also we saw about 70% of the fresh investment coming in from the private corporate sector. This year also it is as high as about 68 to 70%. So I think these are the numbers which gives me the confidence, and what I mentioned in terms of the pipeline which is there with the bank. So that very clearly is actually a reflection of the kind of mood which is there in the economy as far as the fresh investments and development of the credit is concerned.
Okay, so the mood is looking strong. Mr. Shankar, Raman, you're the other gentleman on this panel with a check on the mood as far as the economy is concerned, and animal spirits as well. So let me get a sense from you. Mr. Khara was talking about demand visibility and how that continues to hold, and it's looking strong. Utilization rates, depending on which sector you operate in, between 65 to 70, or as he pointed out, 75%. What's the sense that you're getting? The government continues to front load as far as capex is concerned, and as part of the pre-budget consultation process that's underway, that's the number one ask from industries, that the government must continue to do the heavy lifting when it comes to capex. What are you seeing on the ground at this point?
I think...
Okay.
Thank you, Shereen, and thank you everybody for having me here. I think India is in a unique place. I do not know whether it is providence or whether it is planning or it is a combination. We went through the turmoils of the last 2.5 years rather well. And what that has done to us when we sit in the boardroom and keep debating about what next, what it has done to us is given us a sense of self-belief that the country, its ecosystem, and given all the challenges that we face, sometimes I do think that the fact that we are always asked as a country, as people, to do more with less, because we always resource-starved economy, resource-starved system. So the accent is always to see how best you can extract. You can't help some amount of trickstering happening in this, but setting that aside, the fact is all of us think that India is in good position to dream about its aspirations for the next 20 years or 25 years. To that extent, I think the name Amrit is so very fitting, that it does indicate how we feel about India. There are a lot of things going for India at this moment. Obviously, I think There's a very aspiring population which wants to make a difference to its own living standards, etc. And a government which is very keen that the growth should be inclusive. And I think Mr. Khara made a point in this opening remark about the divide between village and cities. I think if I look at 3-4 cornerstones of our plan, inclusivity comes to my mind very strongly, because I think all that the government is talking about is to get more people on the train, to make sure that all productive resources are deployed. I mean, I could even think in terms of the goals that we have internally as an organization to get more women included into the workforce, because 50% of India cannot operate at sub-productive level given the fact that they are as intelligent and as resourceful as people. So given this, I think inclusivity is going to be one reason why all corporates feel that the time ahead is favorable. The second most important thing is also the fact that we are looking at productivity. I think most of the investments, when we came out of the pandemic, even through the phase of the pandemic, all that we were focusing on what to invest in to make ourselves more productive. Because obviously the resources were getting scattered, so we had to get our machines to do more than what people could do originally. And all of that led to IoT, and thankfully the technology never slowed down in this phase. And we were able to exploit the technology to make the machines produce more. So productivity was another key factor. The third important factor, according to me, is sustainability. I think thanks to this disruption that has happened in the world in the last 3, 4, 5 years, we are now beginning to look at every initiative as, will this last the mile? Is capital allocation going to be faulted for betting on the wrong horse? A lot of thought actually goes into it. And today our board is demanding scenarios rather than just going with the management's enthusiasm to put capital to work. So what if it goes wrong? What if this doesn't play out? Becomes a very more natural way to evaluate proposals today. And lastly, I think the government's thrust on infrastructure building and investment is music to our ears. As a representative of a company which thrives on infrastructure building out, we think that we are in for a period where investment in the core infrastructure, be it transportation, healthcare, be it in terms of public spaces, utilities, water, power. I think India is so underserviced as an economy, and it is at the other end of its aspiration, that unless we provide a bridge between the aspiration and the enablers, India is not going to get its targets right. And I think the government does realize this. So that is another reason why we feel as a company that if this is the kind of stress that's going to be placed on these kind of levers, then I think India and Indian industry should do well. Just on the point of animal spirits, I think it's very nice of the government to stand up and sort of goad our spirits. But they must realize that we are coming off a period of 4 years, 2 years of pandemic, and 2 years prior to that, the economic growth had actually weakened. And as Mr. Khara was saying, the balance sheets were damaged. So consequently, I think a lot of focus was getting the act together, getting the house in order. I think now that largely that has been achieved, maybe the minister, finance minister, could possibly see demonstration of the optimism coming through in plans.
Well, that's good to hear, and I'm sure that will be music to the ears of the finance minister. You know, Mr. Shankar, let me just ask you a quick follow-up, and I do want to shamelessly plug an initiative of ours, since you brought up the issue of inclusivity and gender parity, because on the 25th of November, we're launching a mega campaign called the Future Female Forward campaign, which is exactly on this, is to try and ensure that we have more women in the workforce, and we address the cause and not the result side of the picture. Why are women not joining the workforce? So I'm glad that you brought that up. But I also want to understand, as far as demand visibility is concerned, you said that this is a good time for the government to go out there and break this vicious cycle of under-investing in infrastructure, which has been a process and a journey that the government has been on over the last few years. What's the order book looking like? And given the risks that we see in the global environment, how significantly is that likely to impact the global order book?
See, I think the fact is, we have headwinds all around. I think we can't overlook that point. I mean, what could go wrong? We don't know how the escalating geopolitics, where it is going to take us to. There are a lot of conversation around recession and the extent of recession. We do not know how that is going to play out. We also don't know the impact of runaway inflation. If some of these things were to consistently play out for some more time, inflation is going to become a conversation in the boardrooms when we sit and decide on plans. And now, given these kind of headwinds, I think what we would like possibly to do is to play to the strengths. I think the fact that India has demographic advantage is something that we should not overlook. Almost a third of the population coming into the workforce is coming from India. If you project over to 2050, I think the period between now and 2050 is the period where we will have workforce in their early 30s, mid 30s, and that's prime. And I think that's something that we need to exploit. Secondly, I think we are blessed with innate engineering and digital skills. And this is something that we find it very, very happy situation to be in, because I think the IITs, the strategy firms, the Wall Street and all of that are taken away the IIT ends. So we have to look at the next level of next rung of colleges and universities. And when we go deeper into the Indian universities, we find that the skill level is definitely something that we need to take heart from, because I think what they lack is opportunities. If those opportunities can be provided, and using technology to provide that, then that becomes another big factor. So to my mind, I think if we don't make policy errors, if we are able to make sure that the investment plans or project plans, I'll talk about project because that's what I'm more intimately connected with, and that's what is going to reflect in our order book end of the day. So when I look at project plans, I think a lot of sponsors are wanting pre-clearances. I think the clearances as we go along in the project actually is a big risk that we need to deal with. So the extent to which you can pre-clear some of these risks and enable the projects, I think the capital will find its way much faster and smoother. The third thing that we need to actually worry about and also talk to government is optimal risk sharing. When you have these contracts and projects, particularly in partnership with government, or any of the agencies of the government, there is certain amount of disproportionate distribution of risk. I think the belief that private capital can court larger risk is, I think, a misplaced belief. We need to make sure that in all these partnerships, partnership in its true sense means holding hands right through, and not just leading the horse to the pond and watching the fun. So to that extent, I think the system has to evolve. Be it the bureaucracy that drives all this implementation, or even the thought leaders in the government needs to own up the risks as well, and not just talk about what can be done, also has to enable. The fourth thing that we need to do is, in all projects implementation contracts, disputes are bound to happen. The pace at which we are resolving disputes is leaving a lot to be desired. I think we've repeatedly come across situations where the sanctity of the written contract gets questioned. And if you're going to sit across with a counterparty who's more powerful than you are and get into conciliation, the conciliation can go only one way. And that would mean loss of value for private capital. And if that is going to happen, the banks are going to get worried who have funded the projects. The equity investors are going to get worried. So consequently, I think there has to be a sense of responsibility when it comes to project sponsoring, and that is something that we'll have to learn. Now, if some of these things we do well, I think growth in order book is not going to be a constraint. Our ability to build skilled workforce, our ability to automate our processes, be able to deliver on ground is what will drive the order book finance.
Mr. Rao, you know, we were talking about policy intervention. And one intervention that the government made in the month of May was bringing in the export duty on the steel sector. And of course, there were other changes as well. Industry had no choice but to accept it, but that has now been reversed. But given the global environment and given where global prices are and domestic prices are, will it materially change things in the short term? And more importantly now, as we're looking at demand visibility, Mr. Khara and both Mr. Shankar, Raman talking about the infrastructure build-out, what are you pegging as far as demand visibility is concerned, not in the near term, but over this decade, if this is going to be India's decade, so to speak?
So good afternoon. Thanks for inviting me. Number one, when Finance Minister was asking in various forums why private sector is not investing, when so many reforms have been done, so many building blocks have been built over the last 70 years, 75 years, and there is nothing which private sector can ask for, because the tax side there are so many benefits that have been extended. But if you see last 3 years, even though demand is there, supply side there were so many constraints. Either you call logistics constraints or the supply side constraints. We were not able to produce in many industries. Demand was high, but supply was not there. That's why inflation cropped up in several sectors. But it is the first time where we are seeing that the capacity utilization in the manufacturing sector, it is a 3-year high. It is almost 75%. That is why company by company, sector by sector in the private sector, today is announcing that they would like to commit capex, or they are in the process of implementing various projects to meet the ongoing demand. If you look at the commentary in the last at least few months, it is completely changed. Earlier, whether the growth in India as far as GDP growth is concerned, we will continue to do at 5 to 6%. Today it is not. We are going to reduce our GDP growth, but whether we will grow at 6% or 7% or 8%, that is the story which everybody is talking about. But one important point, when manufacturing sector is creating capacities in India, it is not only to meet domestic demand, it is also for export markets. If our merchandise exports is over $400 billion, our service exports are $250 billion or $250 billion. So $650 billion are intended for export markets, where today global economy is slowing down. Everybody is talking about inflation to recession. Interest rates are going up. The situation is not dramatically going to change in the next few months. It will take some time. So when $700 billion of Indian economy is dependent upon global economy, then we say we will grow at the rate of 7 to 8%, at least in the medium term or in the short term. That may be a little optimistic in my view, because it is very important global economy also will recover if we have to accelerate our growth. But what is comforting to us, when everybody is talking about recession, as far as India is concerned, we are growing at a rate of 6% and only debating with 7% or 6%. That is the whole debate is happening. To answer our question, when export duty was imposed, as government clarified or industry has clarified several times, that was intended only to contain inflation. So inflation has come down, duty was removed. But the point remains is whatever capacities that have been created in India, particularly steel sector, if I look at it, 154 million ton of installed capacity has been created in India, which was 15 million ton in the year 1990. So there is a lot of capacity which has come in. Out of that, in the last year, 2022 March, India exported 19 million tons of steel from India. And at the same time, engineering exports have grown so high in the last year. It is $112 billion of engineering exports. It is steel intensive exports. So when these exports are got affected, notwithstanding demand growth is there in India, is it possible to continue to create capacities until global economy recovers? May not be possible, because we are creating capacity here because we are competitive. That is why we are creating capacities in India to meet domestic demand and also the global markets. So at the same time, what is really interesting here, in the year March 22 financial year, India consumed 106 million ton of steel. Whereas in this year, the growth is 11%. That means our demand will be 115 million tons. 9 million ton more growth. Can anybody say India is not growing? India doesn't have potential? Impossible. Similarly, if I look at next 25 years, the kind of investments that are required in India, building our country, huge amount of cement, huge amount of steel, huge amount of metals required. So demand growth continues to be robust. But what is impacting today, 20 million tons of steel which was exported, it becomes half or less than half. There is 8-9 million ton of steel is getting exported in this year. Whereas our imports are growing, exports are coming down, domestic demand is growing but not able to absorb fully. That is the situation today. This may be true in several sectors, not only steel. But the point remains here is, if I look at next 25 years, taking into account the building blocks that have been created by the government through various reforms, starting from 1990, which started with industrial licensing reforms, import relaxations, connectivity reforms, which they have done, national highway building, telecom, connectivity, all this which they have done, even that has not given enough momentum for growth in India. What has given the momentum, as Mr. Shankar Raman rightly pointed out, is to meet inclusive growth, basic needs of the society to reduce inequality. That is what really this government has addressed in the last few years. Inclusive growth is the main focus. 2013 or 14 onwards, the kind of reforms which has been done, housing for all, electricity for all, gas for all, Ayushman Bharat. If you look at all these welfare schemes which have been announced by the Government of India to reduce this inequality, and we will be able to build on the blocks of reforms that have been done by Government of India, we will be able to accelerate. Similarly, the kind of reforms with regard to basic reforms or fundamental reforms, either GST, IBC, Gati Shakti, which is talked about, these are all great reforms. In fact, the manufacturing sector, what is there to complain? The tax rate is today 25%. If any new manufacturing company, if it has started investments in the last few years and completing the next few years, then it is 17%. So therefore, there are very good building blocks for accelerating investments in manufacturing sector. In my view, manufacturing sector has a great future to meet our domestic demand and also to meet global demand. But the fundamental core, we should not forget, aligning India's strategy with what is happening globally. Those two themes are sustainability, which Mr. Shankar Raman pointed out.
Yeah.
So there we are looking to the government only to look at in the budget, is that if we want to export today any of the merchandise exports, it is very essential that our carbon emissions are lower. So carbon trading is very important as far as India is concerned. So in that regard, if something can be done, then we will become very competitive while exporting many of the merchandise products from India.
Well, all I can say is that, our reporters who pound the pavement practically every day suggest that this budget is going to have a green focus, is what we're given to understand. So let's see how much of that is translated into some of the recommendations that you spoke of. But, you said, Mr. Seshagiri Rao, that the manufacturing sector today has nothing to complain about, and the road is really set for growth and for building out capacity over the next 25 years. One specific recommendation that's come in from industry is that, look, this 15% concessional tax rate, which was extended to 2024, should now be given a 5-year extension. So that gives foreign investors, domestic investors, a very clear roadmap, especially in the context of people looking at finding an alternative manufacturing destination outside of China. Do you believe that that is a legitimate ask at this point in time? And also, you were talking about reforms. I want to understand from you, the PLI scheme for the specialty steel sector has been rolled out. I believe 79 applications have come into the government. But given the domestic demand situation as well as global demand at this point in time, do you believe that fresh capacity is likely to be added soon enough?
So to answer your second question, PLI, production linked incentive for specialty steel, it is not creating a basic steel capacity. So whatever imports we are doing of specialty steel, like electrical steel, which we are importing 100% into India. Similarly, something related to API grade steel or automotive steel, where we are importing, PLI scheme is getting extended only to the specialty steel. That means basic steel making already exists in India.
Right.
We need to go into high-end value-added steel. For that, PLI scheme is introduced. 79 applications have gone itself, is showing that there is a lot of interest in setting up those capacities in India. to stop the imports and also to enable Indian steel industry to export, as far as that particular point is concerned. Second one, you...
On the concessional tax rate being extended by another 5 years.
So in fact, this concession of 15% was given in the year 2019.
Yeah.
And they said by 2023, whatever investments that are made, those investments should be completed and it should be commissioned. Whereas at the request of the industry, it has been extended by 1 more year.
Correct.
But because of this offshoring and also China plus 1 policy, if it is extended, it will be great. It is a welcome step.
Now, Mr. Chhatwal, let me ask you, what's happening in the bond market? Bond issuance is telling you that risk appetite is on the cusp of being unleashed at this point in time. What's the sense that you get?
No, thank you. Thank you for inviting me, Shereen. Yeah, bond market, I think, has been a bit of a challenge over the last 18 months. And this happens typically I mean, this is bond market and we have a lot of bankers here. So I think it's a trade-off. Usually when the interest rates are going up, the banks are cheaper, so there are less bonds. But the other way around, when that happens, the bond markets pick up. So I think we are, over the next 6-8 months, coming to a situation where we will see interest rates peaking out and coming up. But I think it's a collaborative partnership with the bond markets. Really over the last few years have matured significantly in terms of the investors who are coming in terms of the quality of paper which is coming into the bond market. I think we are with the whole this whole infrastructure financing. While today banks are doing the heavy lifting, but we today are creating building blocks within the bond market for that growth. The REIT the regulation, I think, was a tepid one when it initially came in. People didn't want to kind of the first to happen, and then it was silent for a long period of time. But today, when you look at how the infrastructure is being built up in the country, I think REIT and REIT is possibly the best thing which has happened to the country. You could, while I understand what Mr. Shankar Raman was talking about, the headwinds in contract, etc. But I think from what we've seen 10 years back or 15 years back, when we saw the infrastructure build up with all these BOT projects and huge amount of losses and projects coming down, I think today what we are seeing is a much cleaner build out. By and large, and I will step back from what Mr. Shankar Raman said, by and large the contracts are fairer. We've have some of these tested in a court of law where at least you have some judgment comes in, at least the cash flow starts. We have a situation where vehicles like REIT and REITs kind of, I mean, Mr. Khara said that it's a largely debt-funded investment. The moment you put into a REIT and REIT, it automatically comes to 50-50. So, and you have a retail participation, which is picking up. Obviously, initially it wasn't there. So I think that regulation per se has, personally think I would really revolutionize that, and the bond market will have a role to play there. Some of the areas we think it is something which we like to see develop on that is the secondary market liquidity. Today, I think we are having a challenge in the bond market that the liquidity in the secondary market is not enough. We had government talking about a credit guarantee corporation. Like today, when you have shocks, we have the government of India coming in and doing repos and kind of, but on the corporate bond side, we don't have anything. While I don't want to get into the legality of it, but we had a large mutual fund having problems with credit funds. But in the end, every single paisa got paid. And most of the ratings there were A and AA. I think what we are seeing today in terms of the quality of ratings we are seeing in the A, AA, today are far superior than they were 20 years back. So I think all of that and the fact that we have international investors coming in, many of the REITs investors are owned by pension funds, and those, all of them are putting in money. The governance levels are very different. Yeah. So I think a healthy time for the bond market.
Healthy time, but you know, on the issue of financing, and I want to pick up on what we heard from Mr. Shankar Raman as well as from Mr. Rao and Mr. Khara. And given the needs of capital, given the fact that we want this sort of large infrastructure build out, etc., Mr. Chhatwal, what is the kind of unlocking of pools of capital that will really be required to get to this aspirational number that we're talking about, and what kind of financing instruments, especially when we talk about sustainable financing, we talk about climate financing, etc. Renewable is a big aspirational target that's been set by the government, etc. I mean, pools of capital, where do we find them?
So if you frankly ask me, I think there's a decent pool of capital which is coming through India. I think when you have, I think as an economy, we are moving away over some of the hurdles. I mean, for example, we said contract resolution, retrospective taxes. I think some of those we've set right. People abroad have different risk spectrum. I think they take those calls. Today, I mean, I sometimes say that Canadian pension funds today are more bullish on Indian infrastructure than many of us are personally. I think the kind of money they're putting in. So I think it's the different risk spectrum of people coming in. But the fact that we are setting things right, we're setting a sustainable growth in infrastructure. We are coming to a situation where the bank NPAs today, by the end of the year, will be 5. And if NARCL, all of that kind of gets resolved, it'll probably be 4, which are historical numbers. So I think we have a pretty clean balance sheets. The corporate balance sheets, if you see today, 5 years back, for the 7,000 companies we rated at CRISIL, the gearing was about 1.1 thereabout. Today, the last half year we looked at it, it was less than 0.5. People have the ability to grow. What I'm trying to say is that with the way and the way we grow, and I understand that people want to grow faster, but I think we are doing the right things. The insolvency law, I think we saw very high ticket resolutions done. But there are work to be done there in terms of getting the right skill set there, the capacity there to be able to move down the chain. So I think some of those work in progress as we move down the road, we will see, and as we are speaking, we are seeing people coming in.
Mr. Vakil is sitting right here. I'm sure he can give us chapter and verse on what needs to happen as far as the IBC is concerned. But let me get Mr. Saraf into the conversation. And Mr. Saraf, just to pick up on the manufacturing theme, a lot has already happened. The question now is what more needs to be done to really build on this alternative manufacturing destination opportunity that presents itself. In your experience, with what you've attempted to do, what more do you believe needs to be done, especially in the context of India finally now getting back to the path of signing FTAs? We've just done one with Australia 24 hours ago. What does the road ahead for you look like?
Thanks, Shereen. Yes, so I think that for India to achieve its target of $5 trillion GDP in the next 3 years, I think export competitiveness plays a very important role. I think, as Mr. Rao mentioned, merchandise export from India was 420 billion, been growing quite strongly. If we compare ourselves to China, and I can speak, being in the manufacturing industry and running manufacturing plants in India and China, China does $3.36 trillion in merchandise export. I think with the China Plus One strategy that that is prevalent right now, it's a great opportunity for India to significantly expand manufacturing exports. I think one of the areas where that can happen is by better availability of raw material. Coming from the steel industry and being a steel consumer, China produces 1.3 billion tons of steel and exports about 66 million. India exported about 19 million tons out of 120 million tons of steel produced, which is quite a significant percentage. In China today, there is tax on export of steel and certain steel products. India had that, and that's recently been removed. The taxation policy, the VAT system in China is heavily geared towards encouraging export of value-added products. I think if something similar can come up in India on a sustainable basis, I think that will greatly boost manufacturing exports from India. we have been a beneficiary of the US tariffs imposed on China, and actually we moved some of our manufacturing from China to India as a result. But having said that, the Chinese government was very fast to intervene when the US imposed the tariffs and actually reduced VAT and increased tariffs to dilute a lot of the impact of the tariffs. And as it so happened, China still cost competitive compared to India in spite of the tariffs. So I think those are some of the initiatives that the government can take to boost manufacturing exports, which is a key part to meeting overall targets.
Talked about how you moved some of the capacity from China to India, and this China Plus One is something that everyone is talking about at this point in time, and we have seen a fair amount of the benefit of this China Plus One go to countries like Vietnam, etc. The expectation is that India will do better and we should not miss out on this opportunity. What is the fear that you have and what are the risks involved in actually being able to realize this opportunity, this potential?
Well, yes, you're right that a great part of the manufacturing has moved to also countries like Vietnam, Thailand, Taiwan, etc. I think in terms of manufacturing competitiveness, I think India still has much better access to raw material, particularly steel, compared to Vietnam, Thailand, etc. Also, India has a good workforce and is also in a better position to manufacture high value-added technological products better. I think the export infrastructure, ports and the overall infrastructure, as that, that needs to pick up, and I think as that picks up, India can do a lot better compared to these countries. But I think overall, India is in a far better position than some of these other countries that you mentioned to take advantage of the China Plus One strategy.
Well, that's good to hear. And yes, a lot of the aspects related to, for instance, logistics costs, transportation costs, those hopefully should also start to be ironed out as the logistics policy, etc., gets rolled out. Mr. Gupta, let me ask you, in terms of the action agenda for change to build on the reforms already taken, since we are talking about the next decade, the next 20 to 25 years, what is it that you would like to put on the table by way of change?
Sure. Thanks, Shereen, for inviting. So I think all of us discussed that how each of us are expecting that India's economy should cross $40 trillion by 2047. And so in my view, like from 3.3 to 40, if it has to go, while the linear growth, which all of us are talking about, infrastructure, manufacturing, exports, and all of that, I think it has to be supported by non-linear growth as well. Otherwise, it won't happen. And the non-linear growth, in my view, is the whole internet economy, which we are seeing, the way the digitization of infrastructure is happening in terms of the internet infrastructure. We are seeing how the smartphone penetration or the now 5G coming in, leading to new businesses getting generated or the new investments coming into the country. I think that is, in my view, will give a clear boost to or a fast forward growth to the $40 trillion goal. And like we have already seen, right, in a country like US, there are like at least 10 $1 trillion plus companies. And if we look at those 10 companies, all are tech companies. So I think tech will play a very, very important role if you have to reach to that goal. I think, just slight diversion, but I was reading one of the long, where one of the economists had studied the long period of economic history, where the 1,000 year of economic history was being read, and it said that till 1850, India and China were the largest economies. So we are seeing only 200-year blip. Yeah. If you look at like 2,000 year history. So the next 1,000 years would be India for sure, one of the things. So I think that's the way.
You've gone beyond the century also. So it's not just India's century.
So I think so that's the way I see. So I think just to answer your question now more specifically around like what reforms one needs, I think in my view, the way the new age companies can be supported by the government in terms of the easier investment coming into the country, or the easier exits when investors look for the taking capital out of the country from the exits which happen in India, the tax regime which happen here, or even for that matter, like we see already the lot of retail, the institutional capital which is domestic. Like today we are seeing the stock market is all-time high. Like if we give some sort of incentives to this capital being invested in the new age companies, like the way you give the tax breaks if you invest back the investment, the gains into the companies. I think if we can do something of that sort.
Perhaps not the right time to ask the government to do that when you're seeing new age companies lose 10 to 15% on a daily basis. I don't think the government has that kind of risk appetite at this point in time, but I get the point.
I think Shereen is like in any economy, I think, or at a long period of cycles, is very common. If something goes up 1000x, it's bound to come 500x. But the net outcome is still positive.
That's why you have venture capitalists, right? Who are willing to write those large checks and wait by patiently. But Mr. Khara, it's an important aspect that was raised there on the dividend of digitization. And we're seeing that play out across a whole host of sectors, including, of course, the banking sector. I remember, I think it was the last year or the year before last, where you said everyone is talking about unicorns, but do you know that is already a unicorn and nobody talks about it? Where do things currently stand as far as your digital aspiration is concerned? And unlocking value at is that part of the plan?
Thank you very much. Well, when it comes to YONO, of course, it's really paying very good dividend as far as we are concerned. The way we look at YONO is one of the very important and powerful distribution channel. And when it comes to distribution channel, when we started, we only looked at it from the retail point of view, but today we have enlarged the scope of YONO even beyond retail. It's now a very important tool or the distribution channel for the corporate. It is a distribution channel for our international operations. It's a distribution channel for the rural. And YONO actually is comprising of three major components. One is a pure play banking, online marketplace, and also financial superstore. It's 3 into 1. So that is something which is a very unique proposition. So in terms of monetization, I think we would rather exploit it fully, sweat it fully to see that we create value for our existing stakeholders, as against thinking in terms of carving it out or farming it out into a separate entity and monetizing it. I would rather think in terms of multiplying the value of the bank for all our stakeholders.
Okay, you're not giving me a very clear answer just yet, Mr. Khara. Does that apply to mutual funds as well?
No, mutual fund is a separate company by itself. It's not a part of the distribution channel. They are the manufacturer. So they are the manufacturer of a product and the services. So I think that's a very separate subject. But yes, of course, YONO is very much integral part of the bank. Okay. I cannot probably think in terms of carving out a limb of myself, and I mean, there's no scope for grafting a limb. So that is almost a situation like that.
Okay. Let me try and see if the audience has any questions here before we get wrap-up comments. Yes, if you can raise your hand, we'll try and get a microphone across to you.
There is due to the quantitative tightening, globally, there will be a liquidity crisis. Similarly, in India now, the deposit growth is lagging behind the credit growth. So when Khara Sahab is saying quite a lot of projects are also getting sanctioned, how are we ensuring liquidity? This is the one question. Similarly, due to the global recession, India was earlier benefited with the FDI, substantial FDI. Yeah. Are there any threat for our infrastructure growth? And one more just connected to that, the layoffs are all taking place globally. So is that trend likely to come to India?
Okay, let me get Mr. Khara to answer the first question as far as liquidity is concerned, and I'll get the panels to comment on the other questions.
Sure. As far as the liquidity is concerned, see, there are a couple of levers for the liquidity. Well, one of the lever is actually the government when they spend the money. That is also one of the important lever. Even while we speak, my assessment is that almost about 2.5 trillion to 3 trillion is a balance of the government with the banks, RBI. So that remains unspent. During the month of November, we did see some kind of a spending happening from the government, and it did ease out some of the liquidity constraints. Going forward, I think the banks have got the excess SLR, and that excess SLR will be utilized for ensuring that there is no liquidity challenge for meeting out the growth needs of the economy. Your second question was relating to FDI also. So I think FDI, we have seen a very mixed trend in the current year. There have been months when we have seen definite inflow coming in, and to my mind, the way inflation is now trending lower in US economy, that will lead to a situation where perhaps the Fed may not be increasing the interest rate as much. So that then again, when it comes to a sustainable demand, India is an economy which assures sustainable demand. So I expect that the natural inclination on the part of all those FDI players would be to look at India, and the flows, I don't think so. It may have some disruptions off and on, but eventually I think sustainable flow should be there on an ongoing basis.
Mr. Khara, you said that you hope or believe that the Fed may slow down the pace of hikes given the fact that inflation has started to ease a little bit in the US. What's the expectation given where we currently find ourselves on the rate trajectory? And we've got the MPC coming up as well in the first week of December. What's your expectation on that?
Well, I think when it comes to the central bankers, probably Fed is supposed to be the bellwether. So let us wait and watch what the FOMC decides. That will probably give us an indication. I think it is little premature for me to comment on that.